What is up, everyone? Welcome back to my channel where we talk about everything business and investing. Today's video is called Investing for Absolute Beginners, No Jargon. And if that sounds like something that you re-into or something that you know someone that would be interested in, make sure to share this video with them because that's what we're talking about today. This video is really designed for people who want to learn about investing, but do and want all the complicated terms and confusing things that come along with it. So if that's you, make sure you watch till the end of the video because I will be sharing some free resources that you can use to start investing in as little as 5 minutes. Let me introduce myself first. I am a qualified accountant, and here on this channel, we talk about everything business and investing. So if that's something that you're interested in, consider subscribing because every Sunday we post a new video. So let's get into it, the basics of investing. Why should you even care about investing? Well, investing is basically just putting your money to work for you so that you can earn more money. And there are many ways to do it, but we'll keep it simple. What we're going to focus on in this video is investing in stocks. Stocks are basically shares of a company that you can buy and own a small piece of that company. How does owning a stock in a company make you money? Well, there are two main ways. The first way is through capital appreciation. That means you buy a stock at one price and then the price increases and you can sell it for a profit. The second way is through dividends. Some companies pay their shareholders a dividend, which is a portion of the company's profits that gets distributed among the shareholders. You'll receive this dividend as long as you continue to own the stock. However, not all companies pay dividends. Google, for example, does not pay dividends. They instead reinvest their profits back into the business to grow it. Whereas a company like Coke, for example, pays out dividends to its shareholders. The next question you might have is, where can you actually invest your money? There are lots of different platforms that allow you to buy and sell investments online. And in the US, one of the most popular ones is a platform called Robinhood. Robinhood is a really good platform for beginners because it allows you to buy and sell stocks without paying any commissions. In fact, buying and selling stocks on Robinhood is completely free. In addition to that, they also have a great user interface that makes it easy for you to understand and navigate through the app. If you're looking for another option, another very popular platform is M1 Finance. M1 Finance is a really great platform for beginners because it gives you access to thousands of stocks and ETFs, which we'll talk about in a bit. But unlike Robinhood, M1 Finance doesn't allow you to trade options or cryptocurrencies. However, they do have a lot of educational resources available on their website, which can help you learn about investing. Another reason why people like M1 Finance is because of the feature that they call Pi. Pies allow you to invest in a collection of different stocks based on certain themes or categories. For example, you could create a pie that tracks the S&P 500, or you could create your own pie based on the types of stocks that you want to invest in. This can be a really helpful way for beginners to get started with investing because you can easily see how much money you're reinvesting in each stock and how that's affecting your overall portfolio. What is an ETF? An ETF is an exchange-traded fund. It is basically a type of investment that contains a bunch of different securities that trades on the stock market as a single unit. For example, an S&P 500 ETF contains shares of all 500 companies in the S&P 500 index. By investing in an ETF, you're essentially investing in all of those different companies at once. ETFs are a really popular investment because they offer diversification, which is really important for reducing risk. And they're also typically low cost and easy to trade. Some examples of popular ETFs include the Vanguard S&P 500 ETF and the Schwab US Dividend ETF. The next question that you might have is, how much money do you need to start investing? Well, the good news is that you don't need a lot of money to start investing. In fact, you can start investing with as little as $5. With platforms like Robinhood and M1 Finance, you can buy fractions of shares, which means you don't need to have enough money to buy an entire share of a stock. For example, if a share of Apple costs $130, you can still buy one share even if you only have $20 to spare. You just have to buy a fraction of a share. The next thing you may be wondering is how often should you invest? It's generally recommended that you try to invest regularly, such as on a monthly basis. Regular investing can help you take advantage of dollar cost averaging, which is basically the idea that by investing a fixed amount of money at regular intervals, you can reduce the impact of market volatility and potentially increase your returns over time. However, it is important to note that past performance is not indicative of future results, and there is no guarantee that dollar cost averaging will always be profitable. It really depends on the market conditions when you're investing. Another question you may have is, how much of my money should I be investing? That's a great question, and it's one that a lot of people struggle with. Generally speaking, the amount of money that you should be investing depends on your age, income, expenses, and financial goals. However, there are some general guidelines that can help you decide how much money to invest. For example, a common guideline is to invest at least 15% of your income. So if you make $50,000 a year, then you should try to invest at least $7,500 of that income. Another guideline is to invest an amount that you're comfortable with and that fits within your budget. It is really important not to invest so much that you're putting yourself in a difficult financial position. So find a balance between investing and saving that works for you. The next thing you may be wondering is, what types of stocks should I be investing in? Well, there are many different types of stocks that you can invest in, but for beginners, it is generally recommended to stick with stocks of well-established companies that have a history of strong financial performance and growth potential. For example, companies like Apple, Amazon, and Google are all good options for investors because they're well-established, profitable, and have a history of innovation. You can also consider investing in ETFs that track a broad range of the market, such as an S&P 500 ETF. This can be a good way to diversify your portfolio and reduce risk. Another thing you may be wondering is, how do I decide which stocks to buy? Well, there are many different ways to approach this, but one of the simplest methods is to choose stocks that you're familiar with and that you believe in. For example, if you're a customer of a particular company and you've had a positive experience with their products or services, that could be a good sign that the company is doing well and has potential for future growth. Additionally, you can look into the company's financial statements, which are publicly available, to get a better understanding of their financial health and profitability. You can also follow the investing strategies of successful investors such as Warren Buffett, Peter Lynch, or John Bogle. Each of these investors have their own unique approach to investing, but they all have a history of generating strong returns. Lastly, the last question you may have is, how long should I invest for? Well, there's no one-size-fits-all answer to this question. It really depends on your individual circumstances and financial goals. However, it's generally recommended to invest for the long term rather than trying to time the market. Long-term investing can help you avoid the risk of market volatility and take advantage of compound interest, which is basically the idea that your earnings can generate additional earnings over time. Thank you guys so much for watching this video. I really hope that you enjoyed it and learned something new. If you did, please give this video a thumbs up and subscribe to the channel for more videos like this. Also, make sure to grab your free stock from the link in the description below. Thank you again for watching, and I'll see you in the next video. Peace.